Welcome back, everyone. I hope you're having a great day as always. And in this episode, we're going to discuss 3 stocks that Wall Street's top analysts believe are a buy right now and have a lot of room to grow going forward. All 3 companies are growth stocks who operate in very different sectors and have all seen a slight pullback back down to their current level with the recent volatility in the market. So for each company, we're going to take a look at their current operations, go over the buy thesis coming from these top performing analysts, and take a look at the company's fundamentals in their operations to see if they'll continue to grow for many years going forward. But before we take a look at that first company, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course today, we're going to discuss 3 different companies that some of Wall Street's top performing analysts like in this very crazy market that we're in right now. And if we take a look at that first stock, it's going to be ticker CVNA, which is Carvana. They currently trade for $237 per share, and on the 12-month chart, they have grown by 165% to a current market cap just around $19.2 billion. But we can see from a high point of over $314 per share back in March 2021, the company has now been on a major pullback, falling by close to 25% back down to this current level. And with the demand for cars skyrocketing as of late, the chip shortage affecting the new industry and the new car manufacturing, used cars have been exploding in demand, and Carvana is a main player in that industry. And if we take a look at the buy thesis coming from this analyst, they believe that going forward, the demand for units will continue to grow at an exponential rate, and their accelerated revenue growth and unit growth over the long term throughout Q2 and beyond is going to lead to the company trading at a much higher level. And they have a price target set at $340 per share, representing 50% upside from the current level. And if you're unaware of Carvana's current operations, they have a very simple goal, and their mission is to change the way people buy cars. They offer a very simple, easy to use platform to buy and sell a vehicle. Their inventory is continuing to grow, and their nice customer service aspect of the company as well is performing extremely well, and their brand has high loyalty and strong satisfaction. And we can see they have a 4.7 rating out of 5, over 88,000 customer reviews, and 96% of people who use the service would recommend to a friend, which is incredibly impressive. And right now, you can see from this picture, they're innovating the used car game with their very own vending machines. Yes, if you've never seen one of these in person, Carvana builds out their very own used and new car vending machines across the country. And currently, they have 28 of these vending machines in operation, which is incredibly impressive and a unique way to sell vehicles and actually take up less real estate than a traditional dealership. Because if you go to a normal car dealership, you see it takes up a huge plot of land, high property taxes, a lot of room needed to lay out all the cars on one single level. But this vending machine option, having them vertical, takes up less physical real estate, lower land costs, and can actually be more efficient over the longer term. And we can see over the past 5 years, this company's been growing every single category. Total markets, so the different industries they're operating in, grew from only 9 back in 2015 to over 272 at the end of the first quarter. The amount of units sold grew 76% year over year, which is incredibly impressive, and their vending machines, they expanded 1 more in the quarter to a total of 28. And of course, total revenue every single year has been growing extremely fast, and their exponential growth is only picking up, and they posted a 104% year over year growth rate over Q1 2021 versus the same quarter back in 2020. And taking a look at the revenue numbers, annually, the growth is impressive, and quarter over quarter, the numbers are still growing, which is incredibly impressive. And as they sell more units every single year, the company's really showing off as a key player in the used car industry. And taking a look, as they sell more units, they get economies of scale, they're getting more efficient, they're understanding their business model a little bit better, they're making gross profit greater than the previous year and previous quarter as time goes on. And their average gross profit per unit over the first quarter of 2021 was $3,656. So Carvana as a whole has been growing every metric at a very fast rate. They're selling more and more units, they're expanding their vending machine network, they have total revenue growth that's exponential in the triple digits year over year, and everything that's growing is very impressive. And if we jump over to Yahoo Finance, their Analyst, which is take a survey of a bunch of different people on Wall Street, and they have a buy rating on the stock as well, coming in at a 2.1, and the current share price of $237 is below the 12-month expectation of $324. So a lot of implied upside for this fast-growing tech-based company that sells used vehicles on the market right now. And after a 25% decline in share price, now may be an attractive opportunity to buy the dip into Carvana, especially when a lot of analysts, if you believe they'll be correct, are liking the stock at this current share price. And like we saw from the investor presentation, they're growing. Revenue's growing, units are growing, and the entire business is expanding. And as the pandemic comes to an end, individuals are still looking for cars. Going forward, a lot less people are going to be using public transportation because of the safety risks. But after we continue to grow, get out of this pandemic, and individuals have more discretionary income, the demand for used vehicles, because of the chip shortage impacting the new market supply, I think will only continue to grow, and Carvana will remain a good leader in that industry, which I think over the next few years will become profitable and remain a long-term sustainable name in that sector. So that was the first name of 3 different stocks we're going to take a look at that was included in the list of Wall Street's top analysts' names to buy now. And now if we jump right in to the second company in the video, it's going to be ticker DKNG, which is DraftKings. The online casino and sports betting app currently trades for $44 and is up by 77% over the trailing 12 months with a market cap right around $18 billion. And again, another company that has seen a major pullback from their highs of over $71 per share back in late March 2021 has now fallen by over 37% back down to this current level. So overall, as the entire tech sector got that rotation out of it, people were selling out of the not profitable companies that had high PEs and transitioning into more value plays, DraftKings was a big name that was affected. But also, this company has not changed. Although the share price has fallen 37%, same operations continue to grow their market share and is the leader in the US online sports betting market, and definitely a company we're taking a look at if you want exposure to that fast growing industry. And if we take a look at the buy thesis coming from this analyst, overall they mention how the entire market's only going to grow exponentially as more and more states and the more highly populated states allow online sports betting, and they've set a price target at $70 per share, implying a 66% gain from the current level. And they reiterated that in the first quarter of this year, the company generated $312 million of total revenue, reflecting a year-over-year growth rate of 175% and absolutely destroying the Wall Street expectation that was set at $237 million. So the company beat by over $60 to $70 million above the expectation and destroyed the prior year. So overall, they believe that's going to continue to grow as more and more states allow these online sports betting. And they believe once the entire population is legalized, the online sports betting market is going to be worth at least $22 billion only within the United States. So it's going to be a massive market for DraftKings to continue to grow in. And we can see currently only 27% of the US population has access to legal online sports betting, and only 11% has access to legal online iCasino games like roulette and all the different options. So right now, only such a small portion of the US population has access to DraftKings and their operations. So just imagine, once this continues to accelerate and more people can use the platforms as more states legalize this form of gambling, just think of how fast DraftKings is going to grow and how fast their top line is going to expand over the next few years. So you have to understand there is some risk buying into DraftKings. The market is not fully exaggerated just yet, but also that's where the potential comes in for these big gains, because people aren't really expecting and don't really know what the numbers are going to come in as once the entire US is populated and is allowed to gamble on online sports. And if we take a look, DraftKings is already the leader in this industry, operational in 12 states, ahead of all of their competitions. So currently, they're the leader, their brand is out there the most, they have a ton of customers and they have a high satisfaction rating, and the people who log on to DraftKings stay there for a prolonged period. And if we take a look going forward, this company is projected to grow at 30% annually for the next 5 years, and currently it's considered a buy, coming in at a 2.1, and the current share price of over $44 is once again well below the 12-month expectation, right around $71 per share. So another company that has seen a slight pullback as of late of over 37%, and now may be a great chance to buy the dip on this brand that operates in the online gambling market that's only projected to see exponential growth over the next few years, and definitely a company to keep your eye on right now that was included in the list of top recommendations from Wall Street analysts. And now if we continue on into the third and final company we're going to go over in this episode, it's going to be ticker GDDY, which is GoDaddy. They currently trade for $81 per share and have grown by 7% over the trailing 12 months, and they are a smaller company with a market cap of only $13.7 billion. And we can see as of late, another brand that's fallen from their 52-week high of close to $93. They've now sit down just over 12% back at the $81 level. And of course, taking a look at the buy thesis coming from these analysts, they believe going forward, the company should reach a price target of $89, so not as much upside compared to the others, but this domain access company focused on e-commerce, digital marketing, and websites is the kind of brand that's going to be operational over the longer term. The internet's here to stay, more and more companies are transitioning online and are starting to prioritize digital marketing as their number one force of growth. And currently, GoDaddy is a brand that's operational in that sector and is a key driver for future expansion of the industry. And if we take a look at their investor presentation, they've been growing year over year as well. Total revenue in the Q1 2021 came in at $901 million, growing around 14% from the prior year. Their bookings were up as well, 14.5%, and their unlevered free cash flow grew 14% year over year as well. And if you want to understand business as simply as possible, free cash flow is the metric. Free cash flow is a company's ability to generate cash after their capital expenditures, and that number, if it grows year over year, a company is expanding in the right way. And in simple terms, free cash flow is one of the most important metrics when evaluating a company, and when we take a look at GoDaddy, every single quarter, their total unlevered free cash flow is growing exponentially, which is incredibly impressive. And we can see a 14% CAGR over the past 2 years. And taking a look, going forward into 2021, for the full year, they project their total top line will grow around 13% to $3.745 billion, total fiscal year unlevered free cash flow of $955 million. Their domain is going to double-digit growth. Their hosting is going to see high single-digit growth. In their business applications, they believe high teens growth. So overall, their 3 business categories all projecting some decent growth, with the total top line expanding by 13%. And if we take a look at their income statement, every single year, this internet-based company has been growing their total revenue to around $3.4 billion in the trailing 12 months and continue to expand every single year. And if we take a look at the expectations going forward, this is considered a buy or a light strong buy, and the current share price of $81 is well below the 12-month expectation of $104 per share. So this price target here, so the average from 13 analysts, is actually above the one from the article that we're taking a look at. So overall, another company with at least another 20% upside to get to their price target from these Wall Street analysts. So overall, that was the third name included in this episode and from the article of the top analysts believe are stocks that are at a buy rating will believe that continue to grow and expand going forward, and definitely worth taking a look at their current levels. So make sure you do your own research. I am not a qualified financial advisor. This is not financial advice, and this is just me going over an article we found on CNBC where other investors and other analysts predict which stocks they believe are a buy and set a price target, which is completely arbitrary for where they believe the stock will be over the next year. So as a whole, take this with a grain of salt. Analysts are not always correct, but I do want to outline the companies that they have their eye on right now and do believe are buys at their current levels. and all three names have seen a double-digit decline from their highs and may be worth buying the dip after you do some research into each company and determine if they fit your personal investing strategy. So thank you for watching to the end. I am the Gen Z Investor, and I will see you in tomorrow's video.